All right, we see that people are still joining, it's good to see everyone. Well, to at least we don't see you, but at least have you here with us during this webinar. So my name is Vlad Tashakov, and I have Oksana here, Oksana Tashakova. We are founders of QPQ. I assume that everyone knows us who joined today. I'll let Oksana to do a proper introduction of our company for those who are here with us first time. I'll just quickly talk about technical things related to this webinar. So in the chat, in about 5 or 10 minutes, I will upload Adam's, who is our main presenter today. I'll upload his presentation, and I will also be uploading links to basically how you can submit your projects to us, because as you well know, QPQ is an investment advisory firm focusing on connecting funders with projects in renewable energy sector. But Oksana, please go ahead and introduce properly QPQ, and then we'll introduce Adam and bring him on stage.
Wonderful. Thank you very much, Vlad. Well, once again, thank you very much, friends and colleagues, for joining us. Many of you already, joined us for our webinars on multiple occasions, and thank you very much. And for those who are new, I will be very brief. I would like to introduce QPQ and why we're doing these webinars. So we are, as Vlad said, we are a deal advisory and a platform focused on funding, helping green energy project developers get funded and secure world-class partners and funders. We focused on green energy, primarily renewable energy, waste energy, hydrogen, and hydrogen production and energy storage. This is our focus. We, as a result of kind of our very focused work, we built extensive network of investors. This is my responsibility in the company. As of today, we have just over 600 leading investors in green energy space, private equity and infrastructure funds, sovereign funds, some large family offices, IPPs and aspiring IPPs. And then, of course, Vlad has been working very hard, and he also built amazing network of developers with whom we work on an ongoing basis. And that is, as of today, we've got more than 850 professional developers with whom we work, and we help them basically scale, bring partners at optimal terms, and help them basically achieve their vision and dreams by helping them secure funding. Yes, and so this is our focus as of today. We are a team of 32 people, and we're growing by one person pretty much every 1.5 months. So that's definitely a source of satisfaction and joy, having reflected on the last few years of very hard work. But I mean, I think everyone is working very hard, especially in green energy space, because planet needs saving, of course, and there is a lot of work to be done. And it's a very, very busy, vibrant sector. And we are blessed to and very happy to see at last that the sector is moving, right? Because a lot of people who went before us in early 2000s lost everything, and a lot of money. Those people who thought that things should happen when they should happen, not like 20 years later, as they did in this case. But anyway, so today our discussion is about how to optimize your tax through clean energy tax equity. Adam is a real expert and a real entrepreneur. Adam has 20 plus years experience in capital markets and venture capital, and he is a founder of Be Green, really cool concept, which he will also introduce and speak about during this presentation. But as you know, many of you are coming back to see to watch our webinars, because we're making sure that we add value. We make sure that this is not sales pitch, that we're not trying to sell you anything, but we're trying to genuinely inform you, because our platform was actually created in spirit of adding value, creating real community, and learning from each other, because we're all venturing in very kind of like a new nascent industry. So learning from each other is very important. And this platform and the spirit of our webinars is learning, basically peer-to-peer learning. So with that, I would like to introduce Adam on stage. Thank you very much again for joining us. I'm excited to hear Adam because he is he's very inspiring and also incredible energy and so much passion that he puts into the business that he's growing. So, and of course, tax equity is very hot topic. It's very niche, it's obviously only applicable to US market while we're working internationally. 30% of our focus, almost more than 30, is actually in the US. And we have, almost five team members in US as well. So would love to be informed and enriched and by your presentation. Adam, please.
Great to have you here with us, Adam, today. So, guys, we're gonna have a quick Q&A session in the end of Adam's presentation. So please post your questions at the. There is for me, it's at the bottom. There is a panel, navigation panel with Q&A button. So you can click on that and type your question. And depends how much time we got left in the end. We'll try to answer as many as possible. And once again, for those who just joined, I'll be posting in the chat both our and Adam's presentations for you to download, and also the link where you can submit your projects for review by QPQ if you're looking for funding. Adam, please go ahead. We're going to be on the background.
Sorry, 1 second. I apologize.
Yeah.
So it's best that we mute and stop video or leave the stage?
No, that's what I was going to say, that we're gonna be on the background. If you need anything, you just let us know, but otherwise we'll just switch off the video. I'll move Oksana to away from the panel as well.
Please, thank you.
All right, thank you, Vlad and Oksana, for this honor of presenting to the QPQ Network, and thank all of you for attending this morning. It's tax season here in the United States, and so this, over the next 4 weeks, I think the tax day is in fact 3 weeks away. And for those who file extensions, tax day will be next September or October. So we really are in the thick of trying to optimize our taxes. And provided that you are like me, and while you feel a civic duty to pay your taxes, you don't want to pay the IRS, anything more that you owe, then this presentation is going to be for you. The Inflation Reduction Act and tax equity are extremely hot topics in the US right now. And I think that you're going to enjoy as well as learn a lot over the next 20 or 30 minutes. And I look forward to your questions at the end of the presentation. So let me share my screen for a moment. How's this? Can you see? I'm going to assume the answer is yes.
Yeah, we can see.
All right.
It's all good.
Wonderful. Yep. So the topic of today's presentation and the theme is tax optimization with clean energy tax credits and tax equity. Now, I do want to state up front, even though Oksana shared a moment ago, that this today's presentation is not a pitch, and it's not a product. It's not a investment opportunity where you're learning about a new technology that's going to go out and revolutionize the renewable energy or storage world of a company that is going to raise successively larger amounts of funding, invest that funding into renewable research and development, have a marketing strategy, production, manufacturing strategy, distribution, et cetera, et cetera. This is all about trying to optimize and minimize your tax liability to the federal government. And so if you're in the boat of wanting to minimize those taxes while potentially doing good for the world, then you're in the right place. There we go. So today's discussion, we're going to discuss a crucially important update to the US tax code that allows for the transfer and sale of renewable energy tax credits. And this is the first time ever that those credits are transferable or sellable. Now, investors who missed this update, which occurred last June 16, 2023, so this is the first tax cycle that it's been implemented. For those investors or taxpayers who missed that update, you overpaid your federal taxes by 10 to 25%. And it's likely that you'll continue to do so unless there's some action taken by yourself and your CPA. And if you did miss the update, that's okay, and there's no reason to be tender about it. We're going to introduce some immediate actions that you can take to remedy that overpayment. So the agenda today will be fairly simple. We're going to discuss the catalyst for this change, which was the 2022 Inflation Reduction Act. We'll introduce what tax credits are, particularly in this case, transferable tax credits, what tax equity is. It's a form or a permutation of tax credits, the returns profile that a taxpayer can expect, the different types of participation opportunities, who can participate and who is eligible, and then we'll finish up with a five-step process for tax credit investors, as well as a five-step process for renewable energy developers or storage developers, how they can participate and sell credits into this market. A bit about me. I've been in capital markets and venture capital now for about 20 years. I formerly worked in structured finance at Morgan Stanley. I've raised and launched my own venture capital fund, and I've worked in technology for about the last 10 years or so. And I'm also the co-founder and CEO of a fintech platform named BitGreen. We're a prominent disruptor in the renewable energy and carbon finance space. We also participate in sustainable aviation fuel, potentially green hydrogen as well. The mission for us is to try to aggregate capital and drive that into sustainable finance markets. Over the last year, we've become expert on the tax benefits introduced by the Inflation Reduction Act, and in working with high net worth individuals and family offices, as well as companies, to help them realize those tax benefits. So if nothing else, at the end of today's presentation, I'd like for you to take away 3 main points. The first is, don't overpay your taxes. There's no obligation. And if you ignore this message today, it's probable that you're going to overpay your federal taxes this year and in ensuing years by 10 to 25%. The information that I'm sharing today, again, it's not an investment opportunity in as much as it's education. This is a tax optimization strategy that exists by way of building clean energy. It also is an opportunity that produces income. What tax equity does and what tax credits do is it takes your federal tax liability and it transforms that into an income-producing asset. I'll say it again. It takes the liability from one's tax obligation and it repurposes that liability into an asset that generates income for the taxpayer. And there's a very, very high beneficial risk and reward to this type of strategy, given that when you pay the IRS $1 million or $500,000, whatever the number is, you've already lost 100%, right? There's a 100% loss ratio. And so with this strategy, it actually returns anywhere from 10 to 25%. Those are private equity and venture capital returns for a risk that is equivalent to fixed income investment grade. So the breakthrough moment, the catalyst that makes all this possible, was in September 2022. The Democratic Congress in the US passed the Inflation Reduction Act. It's the largest public works and infrastructure spending bill since FDR and the New Deal. It's absolutely massive. And then it was most recently implemented, or thereafter, it was only first implemented by the IRS in June of 2023. So that is to say that it is brand new. And most CPAs, CFOs, CIOs, UFOs remain unacquainted with how the Inflation Reduction Act actually works, which is why you may not have heard of it, or your tax counsel or tax accountant have not introduced this opportunity to you. The background or the high-level explanation of the Inflation Reduction Act is primarily 3 bullets. The first, this has created an uncapped amount of public stimulus, estimated anywhere from $500 billion to $1 trillion in catalytic capital in the form of tax credits to spur investments in US domestic renewable energy production, domestic manufacturing and supply chain, as well as energy efficiency. For the first time ever, these credits are now transferable, meaning that if you are a storage developer or you're a renewable energy developer or installer, you can now sell those credits on the open market for cash. Now, look, I will explain in more detail what that transfer comprises, but there's a limitation that the transfer can only take place one time from the developer, let's say party A, to the buyer, the taxpayer, party B. And the Inflation Reduction Act guarantees a 10-year horizon for this program so that there is stability and certainty around this program. If you and your tax counsel were to learn about this and implement this strategy, at a minimum, it will be in production until 2023. So what is the main takeaway for taxpayers? Well, this is a very large federal tax exemption for US accounts. So for individual tax-paying accounts, on the right-hand side, we have an example of a high net worth account with $1 million tax obligation. You now have a choice. You can pay that $1 million tax liability directly to the IRS, and there's a 100% guaranteed net loss from that transfer. Or you can now purchase tax credits under the Inflation Reduction Act. That activity enables you to satisfy the $1 million tax obligation to the IRS, and simultaneously, you are supporting and project financing US clean energy and green investments. The Inflation Reduction Act has anywhere from, I'd say, approximately 18 different categories for how these ITCs are created and that they are eligible to be transferred. And these range from renewable energy development, investment tax credits, production tax credits, hydrogen, advanced manufacturing, supply chain, previously owned vehicles, EV charging stations, even zero-emission nuclear power. Today, I'm only going to refer to renewable energy. However, any of these different sectors are now eligible in the US to, the developers or the sponsors are able to raise non-dilutive project financing from the US government under the Inflation Reduction Act. So to give you a sense of where we are in the market, it's very, very early, although there's a tremendous amount of excitement in the Inflation Reduction Act and tax equity possibilities. We are still in the first inning. So you are learning about this at exactly the right time. However, one word of caution is that the size of the demand for these credits is about 15 to 20x the total supply of tax credits that were issued last year. So you'll see here that I pulled the number for the total federal taxes paid by C corporations in 2022 and the total supply of tax credits that came online in 2023. So what we are seeing is that investors are not only purchasing tax credits for this current year, they are signing multi-year commitments out of fear that there will be a lack of supply of credits when they need them come Q3, Q4, or in future years. And right now, what we're seeing as well is a massive search by C corporations and high net worth accounts seeking 2023 credits to offset their current tax bill. And those credits no longer exist because they've all been consumed. So if this is an interesting strategy to you, I would recommend that you take action and make efforts to try to lock in your present tax credits to offset your current liability in 2024, and try to arrange for some type of guarantee of future offtake for 2025, 26, and 2027. So now let's talk about what are tax credits and what is tax credit transferability. So the Inflation Reduction Act makes the use of tax credits, which are a dollar-for-dollar exemption to a taxpayer's federal tax liability. So these are more generous under the Inflation Reduction Act to developers and manufacturers than they have ever been before. And they've, again, been extended for 10 years guaranteed. And for the first time ever, the developers can sell those credits in a peer-to-peer transaction to a buyer who has tax demand. And this is a little quote from a member of the IRS from 2 weeks ago. I went to a large conference. He said, "We began implementing the IRA last year, and the results have been a blowout success." And you'll probably hear similar feedback from everyone in the market who's been engaging with the Inflation Reduction Act. So if you're a developer, this is what's in it for you. The IRS will provide anywhere from 30 to 60% of the value of your new project in tax credits. And most of those credits are then sold for anywhere between 87 cents to 93 cents. I think the inside market here is probably 88 cents to 90 cents, plus or minus. So therefore, what happens is, and we have these two bar graphs on the right-hand side for comparison. Without credits, project developers typically need to raise their financing from a variety of different sources. They need to come up with their own developer equity, typically around 10 or 15%. They will likely raise money from private equity funds, which is a very expensive cost of capital and a protracted process. And then together with the private equity fund, they'll go to a bank and they'll raise the remaining in some form of construction loan. With the credits, however, that developer can now receive, again, anywhere from 30 to 60% of the financing in non-dilutive, non-interest-bearing equity capital from the US government. And since most developers do not yet have taxable income, given that they haven't built the project, they then go into the open market and they try to sell those credits somewhere for around, again, 87 to 93 cents, bringing in that cash. And then it's less frictioned process for them to go to a bank and then access debt financing. And in many cases, they don't even require the preferred equity from a private equity partner. So it's really game-changing for them. Now, here are the benefits for the taxpayers, in this case, the investors. Buyers can offset up to 75% of their federal tax liability per year. And you can buy credits in the current year and then carry those back 3 years in the event that you paid federal taxes in 2021, 22, or 23. So this is a tremendous windfall, both for taxpayers, the developers, as well as the US government, who's not paying out of pocket for these projects, but instead is just reducing its revenue base. So here's an example of how a simple tax credit transfer works. So number one, let's say that the project developer is a solar developer. They need to register their project at irs.gov, and they receive back credits equal to, in this case, 30% of the project valuation. So a project is worth 100, they receive credits worth 30. Then the developer goes out to the market, sells those credits to an investor for cash. Again, let's say it's 90 cents. So in this scenario, there is 30 out of 100 of tax credits, and that 30 is sold for 90 cents. So the developer has now raised 27 cents of non-dilutive capital. And then the developer proceeds to build the project or raise other financing, and the investor is able to claim the full exemption up to 30, right, 100% of the tax credits off of their federal tax return, either in the current year or going back 3 years. So the return on investment here for the investor would range from about 7 to 13%. And here's an example of how the 3-year carryback works. It's fairly simple. But again, if you paid federal income tax over the past 3 years, 21, 22, or 23, and you have a current year liability, you can purchase tax credits up to 75% of this total amount on the right-hand side. And for the current year, you'll file your taxes as normal, but you will indicate that there's an exemption on your filing. And then for previous years, you would file a revised filing, and the IRS will send you a refund check. So now we've discussed what tax credits are. So what is tax equity and how does this work? So the best way to think about it is that tax equity are tax credits turbocharged. They amplify and maximize the total return to an investor for taking the same amount of risk. But the return is amplified because it includes the depreciation, both at the federal and state level, as well as cash flows from the project. And tax equity is not new. It was actually created by the banks decades ago, but it was very limited in its scope because the credits were not transferable and because only large utility scale projects were capable of using tax equity. And so there was no ability for like long tail community and industrial projects or smaller to actually tap this market. But that has changed now with the Inflation Reduction Act. Last year, just 2 stats, last year there was $25 billion of clean energy tax equity done in the US. Again, this is an enormous existing market. And JP Morgan and BAML were about 50% of that market last year. The key advantages of tax equity, Number one is the return is about double. So the return can be 15 to 25% easily as a target return rather than just about 10% for a tax credit transfer. The risks are identical. The tax equity adds depreciation and project cash flows. And as I'll show you in a graph, tax equity is very similar to a fixed income investment in that it has fixed coupons that pay out at discrete, like definitive scheduled points of time over a 5-year period. And this is how a tax equity partnership flip is structured. I realize that this is a little bit confusing. I can certainly answer some questions about it during the Q&A session. But instead of the developer selling the tax credit, what occurs is that the developer sells the asset into an investor holdco, all right, an LLC that is structured to have a 5-year lifespan. And then after 5 years, the ownership structure in that LLC flips back to the developer, and the investor is bought out for a 5% exit payment. And in the first year, what the investor receives is, number one, they receive the investment tax credit. So they still receive the full value of the tax credits. Number two, they receive federal and state depreciation. Right now, under the Inflation Reduction Act, there's bonus depreciation of 60% at the federal level within year one. So this is a really important point. Within the first year of making a tax equity investment into one of these structures, the investor receives 100% payback, merely from the tax credits and from depreciation. On a quarterly basis, the investor also receives guaranteed cash flow from the project itself. And then again, at the end of the 5 years, the investor is bought out for 5% of their investment total. And I'll show you the breakdown here, but the total return or the multiple on invested capital is about 20 to 25%. This is how the ownership in the LLC can look. And I won't spend too much time here, but during the first 5 years of the holding company's existence, the investor owns 99% of the holdco, the developer owns 1%. These are figures that are, there's guidance from the IRS on how this ought to work. And then after 5 years, the ownership flips back to the developer or the sponsor, and then the investor is bought out. So let's talk about returns for a moment. So let's say that you're an investor and you have $50 million of tax liability. So I've highlighted it here. I'm not sure if you can see on your screen, but this is the profile of an investor as $50 million of federal tax liability. And they engage in a tax equity partnership flip where they're buying tax credits. So in a partnership flip, you actually buy the credit above $1, given that the return profile is so much higher. So I use as an example that the credits are purchased at $1.12 each, and the total amount invested into the holdco by the investor is $56 million. So 50 million times 1.12, 56. The return profile is on the right-hand side for the investor. And let's go through these one by one so that we're very clear. The first is that the investor then receives $50 million of tax exemption, right, from the purchase of the tax credits. They also receive about $11.5 million in federal tax depreciation. That's on an after-tax basis, plus another $1.5 or $1.75 million in state depreciation. Over the course of 5 years, $8.4 million in preferred cash return. And then at the end, there's the exit payment or the exit buyout, which is 5% of the invested amount. So that's 5% times 56 million gets to 2.8 million. In this example, the investment of 56 million results in a total return of 74.35 million on a pre-tax basis. And this is a 1.25 multiple after tax. And this graph really tells you what you need to know. It explains the former graph, but over a period of time. And this graph to me is illustrative of why I say it's like venture capital returns in the 20s, but with the predictability of fixed income. We have time on the x-axis at the bottom. You see at time 0, there's a $56 million investment made. And then in year 1, there's already a break even, right? The investor receives the $50 million of tax credit exemption, plus the federal and state depreciation, plus the cash preferred return, which then continues each quarter for the 5-year period until year 6, where the final preferred cash distribution is made, plus the exit payment. And then the same figures that I showed you on the previous slide are over here on the table on the right-hand side. For this investment of $56 million, the net total profit on an after-tax basis, 18.35. The ROI is about 25%. And you can see here the dotted line is the break even. The investors tend to break even on this investment in year 1. So in review, I'll wrap it up very quickly. There are 3 ways that you can participate in this IRA tax program over the coming decade. The first is the direct, very simple tax credit transfer, where you as a seller, a developer, sell the tax credit for 90 cents, or in the case that you're a taxable account, you're buying the tax credit for 90 cents, and you earn, about 10 cents to $1, right? Sorry, you earn 10 cents, the difference between 90 and $1. There's also the tax equity partnership flip that I just described. So you're then, as an investor, benefiting from the tax credit plus depreciation and cash flows. And the third opportunity would be a debt lender, where you can lend debt that is collateralized by the tax credits and the project itself. That's a very, very common private equity and banking process that we see in the market. And then for your kind of reading, further research, I've explained those 3 options. So again, this is purchasing a tax credit and then monetizing that credit in year 1. And this is the flow diagram at the bottom, plus the rate of return that you can expect. This is the tax equity partnership. Again, the asset is sold into an investor holding company. And then after 5 years, the investment flips back and the investor is bought out. And then there is a huge opportunity here for debt investors to support these projects with, typically these are revolvers, but it's some form of debt that is collateralized by the sale of the credits, as well as the production of the renewable energy, and then the sale of that renewable energy by the homeowner. Now, I'm going to get into the eligibility of these options, but I will highlight that for this option number 3, lending debt, you do not need to be a U.S. person or have U.S. tax liability. This is available for any international lender. So who can participate in these programs? I'm only going to discuss tax credits for a moment and tax equity, not debt, because anybody can be a lender into one of these programs. So who can participate? So the Inflation Reduction Act states that the first category of eligible participants are C corporations, any type of C corp. It can be a U.S. or an international company, provided that they have U.S. federal tax liability. In the event that you are not a C corp, but instead you're a family office, an LLC, a high net worth individual, you can participate provided that you have what's called passive income. And this is where you'd want to work with your CPA to identify your passive activity and your passive income and passive tax liability that you pay to the IRS. But the major groupings for passive income are private equity, GPs and LPs, real estate development, real estate rental income, commercial, residential, doesn't matter, equipment leasing, medical equipment leasing, and operating businesses such as LLCs, where the investor is not actively participating in that business. There is also a category for clean energy industry insiders, and these are individuals who participate in the renewable sector at more than 500 hours per year. Now, there's one other, I'm not going to call it a loophole because it's real, and there is guidance on this from the IRS, and I have a link to that guidance here in the slide and elsewhere in the appendix. So there is a term called material participation. And in case you don't qualify as a C Corp or having passive activity, this third avenue for high net worth individuals or family offices is when that individual participates in the activity, meaning in the project, for more than 100 hours during the taxable year. And they need to make sure that their involvement is material and that nobody in the project is superseding or exceeding their involvement or their total number of hours. So this is actually a fairly common occurrence with family offices. They work with their CPA, plus a manager, let's say Bitgreen, right? The investor would work directly with the manager to develop this type of structure so that the investor is contributing 2 hours per week for 50 weeks, or obviously you can stack those hours. There are certain activities that count toward this, such as attending industry conferences. So if you attend RE Plus or InfoCast, Solar and Wind Conference, that's an easy way to rack up 15 hours out of the 100 that's required over the given year. But you're going to want to work with your CPA as well as a manager to help to structure this, this material participation in order to satisfy the 100-hour criteria. Wrapping up here, so here's a very quick 5-step process for investors. The first is you want to qualify yourself. Are you a C corporation, or are you a subsidiary that has U.S. tax liability? Or are you an industry insider with 500 hours? Or do you have U.S. passive income, or do you intend to try to meet the 100-hour test as a material participant? And did you have federal tax liability in any year from 2021 until 2024? If so, then you are eligible to purchase these credits and offset your current tax liability in 2024, as well as carry those credits back all the way to 2021. After that, you'd want to work with your CPA and maybe, again, a manager or an advisor to try to optimize your tax deduction. And then you would choose the structure that is most relevant to you. That's either tax equity, tax credits, or in the event that you're not participating as a tax credit investor at all, but you're a debt investor, there's always the opportunity to try to underwrite these structures. And then as a seller, you are eligible if you are part of any of those 18 categories from the previous slide that I had flashed. So that includes, but it's not limited to, renewable energy, charging stations, storage, battery development, energy efficiency, and other type of projects. What you would do is you would typically work with, again, some type of advisor, QPQ, and we work with, they work with Bitgreen and others to try to identify tax credit buyers. And then there is a legal and auditing process, and there's also some requirements for project management. So you're going to want to work with an advisor who will be engaged over the course of that 5 years for a tax equity partnership. And then the process for sellers is actually fairly straightforward. You would need to work with an accountant. We work with Novogradac, who's probably the gold standard in the industry for this type of transaction. We also work with Deloitte. It would qualify your assets and the valuation that drives the number of investment tax credits that you could sell. And then there would be some discussion around the timing of when the project is placed into service, and then the organization of due diligence materials and whatnot. Very quickly, with just 2 more minutes, and then let's get to the Q&A, because I see that there are some, I see the notification, the appendix. So there are some risk mitigants and credit enhancements that many sellers will undergo at the behest of buyers. There is insurance against these projects just in case they are taken offline. So those third-party insurers like Marsh & McLennan and Aon are available. And insurance tends to be implemented, I think, for many of the larger utility scale deals, but not some of the smaller ones where it's not cost effective. But it can be an important component of a risk management process for an investor. And then there are other risk mitigants such as equity pool reserves, O&M guarantees, and then typically all of the equipment on like residential, solar residential projects and others have some type of manufacturer guarantee against degradation. There are multiple different categories of bonus tax credits that a developer can receive, domestic content, energy community, low-income communities. We can go into these at a different time if anybody has a question. And now I do want to touch on passive activity because this is fairly novel. Again, this is in the event that you're an investor, a taxpayer, yet you are not a C Corp. There are 2 types of passive activity. The first is a trade or a business in which you do not materially participate. Again, that's, call it like an LLC, for example. And also any type of leasing activity or rental activity or real estate development. So that's even if you do materially participate, you are still eligible to use this program. And for everybody here who's curious and your accounting advisors and your tax accountants, the definition in the IRS guidebook for passive activity is at this URL that I've hyperlinked here. I definitely recommend you go look that up. So once again, at a high level, what are the groupings where you can say to yourself immediately, oh, I think that I have passive activity. This is a strategy that I want to pursue. Private equity investors and general partners, I'll talk about that next. Real estate development, income producing real estate and leasing. So that can be buildings, rentals, billboards, equipment, boats, earth moving equipment. Certain lending funds, there's IRS guidance on this, and LLCs and operating business, provided that you are not the operator of the business yourself. Unfortunately, passive activity does not apply to REITs, and it doesn't apply to portfolio income like stocks and bonds, even though technically that is passive. The IRS thus far does not include portfolio income as passive. Now, if you are a private equity GP or you're an LP in any private equity funds, there's really phenomenal news for you. So any income that is derived from carry or distribution is considered passive. However, it would need to come from a portfolio company that is an LLC. It cannot be a C Corp. All right, so that's unfortunate for venture capital GPs as well as for venture capital limited partners, because typically they only invest into C corporations. But if they're portfolio companies, anyone is an LLC, for example, AngelList is an LLC, then as a limited partner or as a GP, that K1 income, you should be looking out for K1 income, actually, is a good way to put this. That will be passive activity, and you can use the tax credits. And then there's some information here as well. If you happen to be a real estate professional, there's Treasury guidance as well on how you can participate in this program. I would highly recommend that you work with your CPA again to identify what type of income or which income in your portfolio is passive. And that's it. Thank you, everybody. This really was a pleasure. And for any inquiries, if you'd like to reach out and talk about any tax credit opportunities that you have to sell, or if you're interested in participating in a tax credit transfer, a purchase, or in tax equity, please reach out to Eric. He's a director at QPQ, wonderful guy who actually brought me in for this presentation. And Eric has been working in tax equity since 2015 or 2016. And so he's fairly expert as well. Dare I say he's more of an expert than me. Anyway, thank you all so much.
Thank you, Adam. Great presentation. I think it really adds a value to our audience, a US-based audience especially, and also people who can leverage this unique opportunity of tax credits and IRA in general. We have a number of questions, so we still have enough time, so we'll kind of quickly go through them if you don't mind.
Let's do it.
The first question is, can a US corporation invest in a non-US project and fall inside IRA?
Unfortunately not. The tax credits are issued only on US domestic projects. But as a USC corporation, you can buy the tax credits, right, and offset your US federal income tax. But your project that is in international markets will not be able to go to the IRS and then ask for tax credits in order to sell.
Okay, noted. Can you provide some examples for investors on current available opportunities, such as what kind of projects are available, amounts, what are the differences between the three structures presented and current market pricing?
All right, that's a great question.
There are three three questions combined in one.
Yeah, it was many questions, but I think that we can hit two birds with one stone, or three birds with one stone. So the way that I would think about this as an investor would be, number one, what type of return am I looking for? And do I want to participate in a project at the utility scale, which means that you're probably going through an investment bank? Or am I looking for something that is smaller size, like it's maybe a $500 million project, all the way down to, let's say, residential solar happens to be fairly popular as well. And on that spectrum of large utility scale projects, all the way down to residential solar, that's typically the continuum of return. So tax equity on a tax credit on a utility scale solar or wind project or asset likely prices at about 93 or 94 cents. So the investor return is somewhat de minimis. Yet on the residential portfolios, let's say that BitGreen participates in, where we amalgamate or aggregate residential rooftops, the returns there tend to be far more favorable to the investor. They're about 20 to 25% for tax equity. Now, the assets that you will typically see are solar, less wind than you would imagine. Those tend to stay within the banking industry. But you'll see a lot of solar, residential, community solar. You'll see some biomass, fertilizers, farm agricultural waste. You'll see a lot of storage. You'll see a lot of EV charging stations as well. For BitGreen, we have some very, very experienced solar developers who we work with both at the CNI, community and industrial, or commercial and industrial scale, as well as at the residential at the moment. And typically what happens is that, at least last year, up until the very end of the year, at the end of the year, there was a race to capture credits. And now there's not a credit to be bought anywhere on the market for 2023. So you need to buy 2024 credits and then carry those back against your 2023 or 22 or 21 income tax. What we found was that the market was very long inventory, very long supply up until about October. And then suddenly, like, all the CFOs and CPAs woke up and realized they need to purchase these credits by the end of the year. And there was a mad rush for the door until December 31st. And most of the credits were bid up in price. And by the end of December, you couldn't find a credit anywhere.
Okay, very good. So the next question is related to tax equity investment qualification. So how do we know if, how does anyone know if their company or organization qualifies as a tax equity investor?
Oh, that's a great question. So number one, if you are a C corporation, then you qualify. There's a slight limitation on the C corps. It cannot be a doctor, an accountant, or an attorney. Those are personal service businesses. However, whether you're a car dealer or you're Goodyear Tire or you're Airbnb, whether you're a privately held C corporation or you're widely held public C corporation, you are eligible to purchase these tax credits or participate in a tax equity structure. If you're not a C corp, then you need to think, all right, do I have passive activity income from real estate, leasing, as a GP or an LP in a private equity fund, or through an LLC? If yes, then you can participate. And if you don't meet either of those first two criteria, either a C corp or having passive activity, then there's the third option where you can try to meet, then you can work with a manager who would set you up in a structure for you to meet the 100-hour test for material participation. So, for example, we, along with your accountant, would structure a system so that you are contributing 100 hours in a given tax year to the project or the portfolio of projects that you are investing in. And for the 100-hour test, right, that material participation, that makes available your full W-2 and portfolio income, like from stocks and bonds, for offset as well.
Very good. Thank you. I think there is a question that perhaps complements the previous question that came from Juan Pablo Moreira. Could you please elaborate further on how a GP or LP could benefit from a LLC, but not from a C Corp? Being a European LLC, it could be better to open a subsidiary in the US also as an LLC.
Yeah, that's exactly right. So Juan Pablo, thanks for the question. So the reason why the GP LP structure, when the portfolio company is a C Corp, does not work is because the C Corp is already eligible for the tax credits. You get it? So if you're a GP or you're an LP, that entity, that limited partnership is just a pass-through, right? It's a pass-through to the C Corp portfolio company. So you ought to advise your portfolio companies that they can purchase the tax credits directly. So in this scenario, the IRS does not allow a limited partner to double dip, given that the C Corp would then capture the tax, the tax exemption, and then the LP would do the same thing. So if the portfolio company is a C Corp, that is not eligible as a GP or an LP. However, if it is an LLC, then the GP and the LP would be permitted.
Mhm.
because that LLC cannot capture the tax credit itself, themselves.
Okay, makes sense. There is a question from Eric Nissen. What would the return be on hypothetical portfolio of commercial and industrial projects like solar carports, large megawatt?
Yeah, it's a great question. So remember, the return here is going to be driven by the developer. Like, at what price does the developer want to sell the tax credits? And then are they willing to provide, let's say, a preferred return of 2% per year or 1% or 4%? What I typically see is that for larger projects or projects that require debt financing or private equity financing, in addition to the tax credit or a significant amount, the returns are significantly lower than the projects that do not require it. So for the portfolios of residential solar rooftops, we very often are able to generate a 23%, 22, 23, 24% return for the investors. For projects that are larger scale and have significant operating leverage in terms of debt and then private equity financing, the cost of capital is so high that some of those projects will likely only pay you an 11, maybe a 12% return in a tax equity structure. And then if you buy the tax credits outright, it's probably above 90 cents. So as a developer, that's great, right? You're receiving 92 cents. But as the investor, then you're only receiving 8% return.
Okay. So let's have one more kind of practical also situation, and then we'll start wrapping up. So this came from Hasib Kadri. So our commercial client can get 300K in tax credit for the solar they installed this year. Their tax liability is only 100K. Can they apply for a refund and get payment for the 200K? If so,
No.
how do we go about
Yeah, it's a very good question, but the IRS does not provide any direct payment. Actually, I take that back. There are some categories of assets like carbon sequestration, green hydrogen, the small nuclear, where the IRS will write the developer a direct payment. It's called elective payment. But for every other project, like in this case, the asset is solar, there's no direct payment from the IRS. Instead, the developer needs to file for the tax credits, receive those tax credits, and then sell them in an open market. And I see there's just one more very quickly. From the developer's perspective, at what stage does a project need to be seeking tax equity? You would want to be seeking that right just in the year of placed in service, or perhaps before. But that is the timing is kind of relative and customized to the project itself. So I would recommend reach out to Eric and he can maybe guide you through. And if not Eric, then I'd be happy to chat with you through that process.
Adam, you kind of mentioned BitGreen in some parts, and it would be great. Can you just quickly tell the audience what is BitGreen is about, and so everyone can actually understand rather than just kind of getting bits and bobs from what you just described.
Sure. I wanted to focus the presentation on education because I think this is one of the most exciting updates to the IRS tax code in a decade. And it benefits everybody's bottom line. It's a shame that people are not taking advantage of it. But our company, BitGreen, is a tech platform where we operate in trying to create more transparency and more investment opportunities in social and environmental impact markets. Our two largest markets are renewable energy project finance, as well as carbon finance. We also do sustainable aviation fuel and RECs as well. And what happened was we were doing renewable energy project finance, and then last year, these two solar developers somehow found us and then reached out to me and asked, hey, Adam, do you do tax equity? And I had never heard of that term before. And even though I worked at Morgan Stanley and I have my CFA, tax and equity to me, those two terms kind of collide in a weird way. But after hearing about this, I went to Google, I researched it, I was very immediately piqued my interest. And then I read the Inflation Reduction Act itself, and I realized, I had that eureka moment where that light bulb, there was that flash of white light, and I realized that this new legislation and the IRS guidance was going to change the entire US electricity grid and is also going to change how certain accounts pay taxes. And so our company, BitGreen, has been building a technology layer to try to make this process less frictioned, more transparent in terms of pricing and also documentation. And then what we'll also do is we monitor and do all the reporting and tax filings on behalf of the investors. And for the tax equity investment, which is a little bit heavier, we set up all of the legal structures. We work with the developers and the buyer. We also have a tech portal where the developer can log in and they upload all their due diligence materials. The investors can log in at any point, see the investment that they've made, the real-time generation of electricity and performance of that asset. We make the payments, or we also collect payments from the sale of RECs and grid services and electricity. So we kind of play the role of Adam Smith and the invisible hand in the process to try to match the buyers with sellers. And I think that we are one of a very, very small handful cadre of tech companies that are building technology to try to streamline this process.
Perfect.
Great. Thank you very much. Very interesting presentation. So I hope our audience have enjoyed it as I did very much. I have to say, I am trained an accountant and I studied tax, and I understand every time I start kind of getting into this topic is heavy, you know, you just need to read a few times. And I'm glad that we're actually giving people presentations so they can refer to, because it's like this LLC in this case is qualified, but not C Corp. And in another situation, it's vice versa.
Yeah,
and which situation is this, you know? So it can get get quite confusing. And it's good that you actually giving people handouts so they can refer to it, right?
It's like an alphabet soup. You need a CPA who can provide you with guidance on effectively like what is passive activity for you in the event you're not a C Corp, or if you want to structure 100 hours, it has become way more popular with family offices and high net worth individuals than I anticipated last year. But we see this very frequently now. A person would want to work with their CPA in order to structure that type of.
It's always better to have an expert.
Yeah, it's always beneficial to have a CPA.
Yes. So, and also, of course, we do have, with our commitment to always add value and bring most optimal and cheapest kind of like funding sources and channels. We already got tax credit and tax equity expert in our team. We already advise our developers to how to optimize their tax and how to improve their returns of their projects that they're building, and improving their financial models by utilizing this. Of course, if you are based in US. So yes, that's already kind of part of our repertoire. And of course, Adam is also kind of leading the way in this as well. So please feel free to reach out to us. It will be our pleasure to help on this topic, or in funding green energy projects, as always. So thank you so much for being here. Adam, thank you very much for a very interesting presentation, and wishing you a great day. And for those who are in our part of the world, it's evening. Thanks so much.
Thank you, Adam, for the effort and time you put into the presentation.
I really enjoyed it.
I also
thank you, everybody.
Very valuable. And we're gonna email the recording of this webinar along with the presentation that you kind of shared with us to everyone who participated, and also those who couldn't make it today. And please keep in mind that if you have projects that require funding, you can always reach out to QPQ International, send it directly to my email, which Amira will be sharing with you as well, or through the funding accelerator at QPQ website. Thank you, everyone, and have a great day.
Thank you.
Thank you. Bye.
Take care.